The last time these four market signals all triggered together, stocks soared 25% over the next 12 months. Now they're flashing again. Wall Street legend Tom Lee's market bottom framework is signaling a major buy opportunity, but powerful economic headwinds threaten to derail any recovery. The battle between technical indicators and economic reality has never been more intense, creating both tremendous opportunity and significant risk. Today, I'm diving deep into the data to show you exactly what these indicators mean and how to position your portfolio for what comes next. According to market history, we're seeing incredibly powerful breadth indicators that have preceded every major bull market since World War II, but we're also facing unprecedented inflation concerns, restrictive monetary policy, and significant geopolitical tension. If history repeats itself, investors who correctly identify this market bottom stand to generate extraordinary returns over the next 12 months. But timing is everything, and being wrong could be costly. If you want to know how to navigate this market crossroads with confidence in 2025, this analysis is critical. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. Tom Lee Fundstrat's 4 key market bottom indicators and why they matter right now. The Zweig Breadth Thrust, what it is, and its shocking predictive power. What credit markets are telling us about recession probability. The unusual buying intensity we're seeing in the S&P 500 and what it means. How VIX volatility signals support or contradict a market bottom thesis. The macroeconomic headwinds that could derail any recovery. The geopolitical and election factors affecting the stock market in 2025. And of course, my analysis of whether we've truly hit market bottom and how to position your portfolio accordingly. Market bottom. Detection framework. Tom Lee, the co-founder and head of research at Fundstrat Global Advisors, has developed a data-driven approach to identifying market bottoms that doesn't rely on emotions or guesswork. Rather than looking at a single indicator, Lee's framework examines 4 distinct market signals that, when triggered together, have historically indicated we've hit a durable market bottom. What makes this framework particularly powerful is that it examines different facets of market health, from technical breadth to credit markets to buying pressure to volatility. This multidimensional approach significantly increases the probability of correctly identifying a market turn. Lee's approach isn't just theoretical, it's firmly grounded in historical data. For instance, his analysis shows that when these signals triggered in 2009, 2011, and 2019, the S&P 500 delivered exceptional returns in the following months. Most recently, all 4 indicators apparently triggered in April 2025, suggesting we may be at another pivotal moment. What's fascinating about Tom Lee's latest interview work is that he openly acknowledges the chasm between macro bearishness and equity internal bullishness. This isn't a framework that blindly ignores economic reality. It recognizes the disconnect, but also understands that market internals often lead economic data. The 4 pillars of Lee's framework are the Zweig Breadth Thrust, a powerful market momentum indicator, 50% retracement of high-yield OAS widening, a credit market signal, consecutive 90% up days, measuring buying intensity, the VIX closing below a key threshold, indicating declining fear. Let's examine each one to see what they're telling us about the current market situation. Analyzing the market bottom signals. First, let's dig into the Zweig Breadth Thrust, or ZBT. This market top and bottom indicator measures how rapidly market participation is expanding. Specifically, it tracks the 10-day moving average of advancing stocks versus the total of advancing plus declining stocks. When this ratio jumps from below 40%, oversold territory, to above 61.5% within just 10 trading days, it signals a powerful shift in market dynamics. Here's what makes the ZBT so special. It's incredibly rare. Since World War II, it's only triggered about 19 times. And its track record? Nearly perfect. According to analysis cited in our research, after a ZBT signal, the S&P 500 was higher 12 months later in every single instance, with average gains around 23 to 25%. That's not just impressive, it's almost unheard of for any market bottom indicator. The second indicator in Tom Lee's framework examines high-yield bond spreads. When credit spreads widen, it signals increased fear of corporate defaults and recession risk. But when these spreads retrace by at least 50% from their widest point, it suggests credit market normalization and reduced recession probability. By April 2025, high-yield spreads had reportedly retraced over 50% of their prior widening, fulfilling this critical condition. This credit market healing has historically been a reliable precursor to equity market strength. The third signal measures buying intensity through consecutive 90% up days. Trading sessions where over 90% of S&P 500 stocks finish higher. This is exceedingly rare, occurring only about 3 times since 1979 according to some research. When we see back-to-back days with this level of broad buying, it demonstrates overwhelming demand for equities across the board, not just in a few large-cap names. Finally, Tom Lee watches the VIX, the market's fear gauge, for confirmation. Specifically, he looks for the VIX to close below a key elevated threshold. 31 was noted in a recent interview. This decline signals a reduction in expected volatility and increasing investor confidence. Looking at the data collectively, these 4 indicators create a compelling technical case for a market bottom. Since 1978, when similar signal combinations occurred, the market was consistently higher 6 and 12 months later. This statistical evidence can't be easily dismissed. Confronting economic reality. While technical signals look promising, we must confront the challenging macroeconomic landscape that could derail any recovery. This creates the chasm Tom Lee references between bullish technicals and bearish fundamentals. First and foremost is inflation persistence. Though we've seen some moderation, inflation remains substantially above the Federal Reserve's 2% target. The strong labor market continues to put upward pressure on wages, which feeds into service sector inflation, traditionally the most stubborn component. This inflation reality directly impacts the Federal Reserve's policy path. After implementing aggressive rate hikes, the Fed faces a delicate balancing act between controlling inflation and supporting growth. Tom Lee's latest news suggests markets are eager for rate cuts, but if inflation persists, the Fed may keep rates higher for longer, potentially stifling any nascent recovery. Economic growth trends also present concerns. While the economy showed surprising resilience in 2023, we've seen clear deceleration heading into 2025. First quarter growth slowed meaningfully, raising recession concerns. Finally, tariffs and trade policy uncertainty add another layer of complexity, potentially disrupting supply chains and hurting corporate profits. These headwinds create a uniquely challenging environment that differs significantly from historical periods when market bottom indicators triggered. Navigating geopolitical currents and investor sentiment. Beyond domestic economic factors, geopolitical risks add further complexity to the market outlook. Ongoing military conflicts, U.S.-China tensions, and instability in key energy regions all pose potential threats to market stability. These risks can manifest through supply chain disruptions, commodity price volatility, and sudden shifts in risk appetite. The post-election environment introduces additional uncertainty. While election years historically tend to deliver positive returns, the specific policy implications of the election results will be closely scrutinized, potentially affecting Tom Lee's predictions about market direction. Current sentiment indicators provide a mixed picture. The VIX has declined from elevated levels, suggesting decreasing fear. But this must be weighed against other sentiment metrics. Investor surveys show widespread pessimism, historically a contrarian positive. Put-call ratios remain elevated, indicating defensive positioning. Fund flows show significant outflows from equity funds, potentially signaling capitulation. If we examine market history, extreme pessimism across multiple sentiment indicators has often coincided with major market bottoms. One analysis found that buying the S&P 500 during periods of extreme pessimism yielded significantly higher annualized returns compared to buying during optimism. The disconnect between technical signals and fundamental concerns creates both significant risk and opportunity for 2025. Balancing risks and opportunities. Let's be clear about the risks in taking action based solely on these technical signals. First, historical performance doesn't guarantee future results. While the Zweig Breadth Thrust boasts an impressive track record, most of its signals occurred in different macroeconomic regimes, often during periods of falling interest rates, not the potentially elevated rates we face today. Second, these indicators don't preclude short-term volatility or retests of recent lows. Even after previous confirmed market bottoms, markets frequently experienced pullbacks or consolidation before resuming upward trends. Investors must be psychologically prepared for these normal market fluctuations. Third, the current environment presents unique challenges that could invalidate historical patterns. Persistent inflation, restrictive monetary policy, and geopolitical tensions create a backdrop unlike many previous market bottoms. If inflation reaccelerates or growth deteriorates significantly, these technical signals could fail. Finally, election year dynamics and policy uncertainty could amplify volatility in 2025, potentially overwhelming Tom Lee's market indicators until greater clarity emerges. Markets hate uncertainty, and policy shifts following elections can significantly impact stock picks and overall direction. These risks don't invalidate the bullish case from Tom Lee Fundstrat, but they demand a thoughtful, measured approach rather than all-in positioning based solely on technical indicators. If you're finding value in this data-driven analysis of market bottom indicators, hit that like button and subscribe to Harry Bull Run. Your engagement fuels more research on topics like Tom Lee's predictions and market bottom analysis. It also helps me know what content to prioritize. Now, let's wrap up with my bottom line assessment. The evidence for a market bottom in 2025 presents a fascinating clash between powerful technical signals and challenging macroeconomic headwinds. Tom Lee's framework of 4 key indicators offers a compelling historical case that we've established a durable low. The Zweig Breadth Thrust, credit spread improvements, consecutive 90% up days, and moderating VIX collectively form a strong technical foundation. However, we can't ignore the persistence of inflation, uncertain Fed policy path, decelerating growth, and geopolitical risks that create a uniquely challenging backdrop. This tension suggests 3 potential scenarios: a confirmed market bottom leading to sustained recovery, a false dawn followed by further downside, or a choppy range-bound market until clarity emerges. Given these crosscurrents, I recommend a balanced approach. Maintain diversification, consider staged entry into stock picks rather than all-at-once positioning, focus on quality companies with strong balance sheets, and employ disciplined risk management techniques including clear stop losses. Remember, market tops and bottoms are only obvious in hindsight. The challenge is recognizing them in real time with enough conviction to act, while maintaining the discipline to protect capital if proven wrong. Thanks for watching to the end even though I gave you everything up front. Until next time, this is Harry Bull Run.